Welcome to the Byte-Size Brief. Today we are putting Quince Therapeutics, that is QNCX, completely under the microscope. Let's just get right into it because we have a lot to cover.
Yeah, we really do. It's been a pretty wild ride for this one.
A wild ride is an understatement, honestly. The sheer whiplash on QNCX over the last 3 months is, well, it's hard to even wrap your head around. If you've been watching the tape, you know exactly what I'm talking about here.
Right.
We're looking at a company that suffered a catastrophic 97% stock crash, essentially just falling off a cliff. But then, and this is the crazy part, suddenly triggering these extreme pre-market volume spikes of like 149%.
I mean, we're talking trading days with over 1.1 billion shares moving hands.
Exactly. A billion shares. It's just pure chaos on the charts right now. And our mission for this deep dive is to figure out exactly why.
And, to do that properly, to really understand what's driving that kind of insane tape, we have to isolate the fundamental realities from the retail frenzy.
For sure. So what are we actually looking at today to get to the bottom of this?
Well, we've pulled together a really dense stack of sources for this deep dive. We're relying strictly on their most recent SEC financial filings, the raw phase 3 clinical trial data, and a pretty deep scrape of market sentiment and message board chatter spanning from January all the way to mid-April of 2026.
Right, because things are moving so fast, we have to look at what is happening literally right now on the ground.
Exactly. We are looking at a company undergoing a radical forced mutation. We have to look at their balance sheet, their abandoned pipeline, and frankly, the mathematical reality of their survival.
Because looking at all this wild volume and reading the chatter online, the ultimate question for us today is the QNCX a fallen angel about to be acquired and reward the faithful retail investors? Or is it just a retail meme stock running on fumes?
Right. That is the core question. And to get there, we really have to start with the heartbreak.
The pipeline failure.
Yeah. The failure that caused that initial 97% crash in the first place.
Right. So let's take everybody back to January 2026. The company had this lead asset, which was known as EDSP, and they were targeting a disease called ataxia-telangiectasia, or AT.
Yes, AT. And to give some necessary context here, AT is a profoundly devastating, fatal pediatric neurodegenerative disorder.
Oh, wow.
It's an orphan disease, meaning it's incredibly rare. And because it's so rare, funding and researching it is notoriously difficult. Children born with AT typically start showing symptoms before they even reach age 5.
That's just heartbreaking.
It really is. It begins with stumbling, losing their balance, and inability to coordinate their muscles. And unfortunately, they are almost universally wheelchair-bound by their early teens.
Man, and there's currently nothing out there for this, right?
Right. There are 0 approved therapies for it anywhere in the world right now.
Which I guess is exactly why investors were originally so incredibly bullish on QNCX.
Right.
Because the potential to be the first to market with an orphan drug for a disease like this, I mean, that's not just a massive financial win for the stock. It's a monumental medical breakthrough.
Absolutely. And the technology behind this specific drug, EDSP, it sounded incredible on paper.
Yeah, it sounded like science fiction to me. Break down how it actually worked.
So the acronym EDSP stands for dexamethasone sodium phosphate encapsulated in autologous erythrocytes.
Okay, let's translate that out of medical jargon for a second.
Yeah, fair enough.
Yeah.
Basically, they took a well-known, highly potent corticosteroid called dexamethasone. Now, dexamethasone is incredibly effective at fighting inflammation.
Right.
But the problem is it's notoriously toxic to the human body when it's taken at high doses over a long period of time.
So you can't just give a kid high doses of steroids every day.
Exactly. To bypass that toxicity, the brilliant idea was to load this steroid inside the patient's own red blood cells.
Wait, literally injecting the drug into their blood cells.
Yes. Red blood cells naturally circulate throughout the human body for weeks before breaking down. So by using the patient's own cells as like a Trojan horse, the objective was to deliver a very slow, continuous, low dose of the steroid.
Oh, wow.
This would theoretically provide all the neuroprotective benefits to the brain and the nervous system, but without triggering the severe side effects usually associated with chronic steroid use in children.
Things like stunted growth and immune suppression.
Exactly. Stunted growth, brittle bones, total immune suppression. EDSP was supposed to avoid all of that.
Okay, let me try to bring this down to a real-world analogy so we can really picture it.
Go for it.
So basically, it's kind of like building the world's most advanced, heavily armored delivery truck. that being the red blood cell delivery system.
Right.
And it's designed to carry a highly volatile, dangerous package through a crowded city without causing any collateral damage along the way.
That is actually a perfect way to look at it. And the thing is, in the pivotal phase 3 Lynxine trial, that delivery truck performed flawlessly. It did. The safety profile data was exceptional. The drug was proven safe. It was incredibly well tolerated by the pediatric patients. And there were no clinically meaningful safety concerns identified during the entire trial.
Wow.
The children did not suffer those harsh compounding side effects of chronic steroids. So, going with your analogy, the truck navigated the city and arrived exactly at the destination without crashing.
But, and this is just the devastating part for everyone involved, especially those families hoping for a miracle, the package inside the truck didn't actually fix the broken pipe at the destination.
Exactly.
It safely arrived, it didn't hurt anyone, but it completely lacked efficacy. It just didn't stop the disease.
Right. In clinical terms, the trial missed its primary endpoint.
Okay, break that down for us. What does that actually mean in the data?
To understand how they measure success or failure in a trial like this, we have to look at the scoring system they used. It's called the Rescored Modified International Cooperative Ataxia Rating Scale.
Which they shortened to RICARS, right?
Right, RMICARS. They tracked the change in the children's condition from the baseline, the start of the trial, to month 6.
Okay.
The active treatment arm, meaning the kids who got the actual drug, saw a mean change of 0.94. The placebo arm, the kids who got the dummy treatment, saw a change of 2.24.
Hold on, I want to pause right there for a second. Let's talk about what RMICARS actually means in a doctor's office. Because as a regular investor looking at those numbers, 0.94 versus 2.24, that looks like a measurable difference. What are they actually testing when they generate those specific numbers?
It is a highly rigorous physical examination. A neurologist is quite literally measuring a child's physical deficits.
Like what?
They are asking the child to walk a straight line, to track a moving object with their eyes without moving their head, or to touch their finger to their nose. They actively grade the severity of the tremors and the lack of coordination.
Okay.
And in this scoring system, the lower the score change, the less the disease has progressed. So visually, a score of 0.94 objectively looks better than 2.24.
Right. So if the drug group only worsened by 0.94 and the placebo group worsened by 2.24, why is the FDA and why is the market calling this a catastrophic failure?
It fundamentally comes down to the ruthless math of statistical significance.
Ah, the math.
Yes. In scientific trials, visual differences just aren't enough. You have to definitively prove that the difference between the drug and the placebo didn't just happen by random dumb chance.
Okay, and how do they prove that?
You measure it with something called a p-value. The FDA generally requires a p-value of less than 0.05 to consider a drug undeniably effective.
Which means what exactly?
It essentially means there is less than a 5% probability that the trial results were a fluke.
Got it. And what did QNCX get?
QNCX's trial resulted in a p-value of 0.0851.
Oh.
Yeah. It missed the mark. It simply wasn't statistically significant. Furthermore, it also missed its key secondary endpoint, the clinical global impression of severity.
Okay, what?
That's a broader assessment by the physician of how the patient is doing overall, so it failed on multiple fronts mathematically.
And the market reaction was completely unforgiving. The moment that data hit the wire, QNCX plummeted 92% almost overnight. Fortunes were wiped out in seconds.
Complete devastation of the market cap.
But it wasn't just a bad day on the stock market. The company officially announced they were ceasing all clinical development of EDSP. They didn't try to tweak it. They didn't try a different dose. They just completely shelved it.
When a biotech company's lead asset fails in phase 3 like that, the fallout is absolute. The entire valuation model of the company, which was entirely predicated on commercializing that specific drug, is instantly rendered obsolete.
Right. So you have this massive, devastating failure. The drug is dead. But, the company still exists, right? People are still expecting paychecks. The rent on the laboratories is still due. What actually happens to the bank account the morning after a crash like that?
Well,
let's actually dedicate a minute to this quarter-over-quarter shift, because when I look at the filings, it feels like looking at two completely different companies.
the fundamental transformation is stark. If we look at the previous quarter, which would be Q3 of 2025, the company reported having $26.3 million in cash.
Okay.
At that time, they were a functioning entity with a fully funded clinical team, eagerly preparing for the phase 3 data readout. They were operating with a clear mandate and the capital to support it.
Right. They were a traditional cash-burning biotech company waiting for their big moment. But looking at the sources for Q1 heading into Q2 of 2026, they are in total survival mode.
It is.
They implemented severe headcount reductions. And things got so chaotic that on April 1st, they actually had to notify the SEC of a 15-day delay in filing their 2025 Form 10-K, which is their massive annual financial report.
Yes, the 10K delay is a huge red flag for a lot of investors.
Well, I'd imagine if you're suddenly firing half your staff, abandoning expensive global trials, and breaking laboratory leases, the accounting behind the scenes is a complete nightmare. Is that what's causing the delay?
That is the exact reality of a corporate wind down. Shutting down a global phase 3 clinical trial is not as simple as just locking the doors and walking away.
I assume not.
You have complex severance packages to negotiate and distribute. You have massive write-downs of clinical assets that are now valued at zero.
Oh, wow.
You have to unwind contracts with third-party clinical research organizations across multiple different countries. The auditors are basically forced to untangle a massive web of liabilities to figure out exactly how much debt is left on the books versus the remaining cash.
Just make sure they're legally accurate under SEC guidelines.
Right. It requires extra time just to figure out what the company even is anymore.
Hold on, though. If they're slashing headcount, abandoning trials, and delaying their 10K just to figure out the math, does QNCX even have enough cash to keep the lights on for regular investors hoping for a turnaround? I mean, $26.3 million from last quarter sounds like a lot of money to a regular person, but in the biotech sector, that can vanish in a matter of months.
You're right to be skeptical. The cash runway right now is highly constrained. Based on the projected burn rate in the filings, that remaining cash is potentially only going to last into mid to late 2026.
That's right around the corner.
It is. And even stretching it that far is heavily dependent on whether outstanding stock warrants are exercised by investors, which would, slowly trickle in a bit of extra capital.
Right.
The harsh reality here is that QNCX does not have the luxury of time. They cannot sit in a laboratory for 3 years and invent a new drug from scratch. Immediate, aggressive, strategic action is the only path forward.
Which brings us perfectly to the pivot. Because, if you looked at the stock charts in February, out of nowhere, QNCX had this massive 300% rally.
Yeah, that caught a lot of people off guard.
And it wasn't driven by a new drug discovery. It wasn't a sudden FDA approval. It was driven by a press release stating that QNCX hired a firm called Byte-Size Capital to explore strategic alternatives.
We really need to decode what strategic alternatives usually means in the biotech sector.
What does it mean?
It is the corporate equivalent of putting up a giant flashing for sale sign on the front lawn.
Wow, really?
Yes. When management publicly announces they are bringing in an advisory firm to explore a strategic alternative, they are waving the white flag. They are admitting the company cannot survive in its current form.
So Byte-Size Capital was brought in to do what exactly?
To look at mergers, reverse mergers, outright acquisitions, or piecemeal asset sales.
So they're essentially looking for a buyer for whatever is left of the house.
Exactly.
But here's where it gets really interesting to me. Just a few days ago, late March into April 1st, 2026, management executed what looks like a masterstroke.
The debt settlement.
Yeah. They had this massive $16.4 million debt obligation hanging over their heads with the European Investment Bank. And they somehow settled that entire debt by paying just $5.5 million. Why would a massive European bank agree to take such a huge haircut?
It comes down to the ruthless mechanics of venture debt and liquidation preference.
Okay, explain that.
The European Investment Bank looked at QNCX's failing clinical trial, their rapidly depleting cash pile, and quite frankly, the impending cliff of insolvency.
Right. They saw the writing on the wall.
Exactly. They realized that if QNCX went bankrupt and had to be liquidated in court, the bank would likely get absolute zero after the lawyers and secured creditors took their fees.
Oh, wow.
So taking 33 cents on the dollar, walking away with $5.5 million in guaranteed cash was the logical, risk-adjusted move to salvage some capital from a dying asset.
That's like negotiating a massive underwater mortgage down to pennies on the dollar just by proving to the bank you're about to go broke.
That's a good way to put it.
I mean, for a regular investor looking at this, that is a huge win. That specific move cleared a massive toxic overhang. Because if I'm a rival company looking to buy QNCX, the last thing I want to do is inherit a $16.4 million debt load with strict European bank covenants attached to it, right?
Obviously.
By clearing that out, management just gave themselves the flexibility to actually execute a merger or a buyout without that anchor weighing them down.
Yes, but keep in mind, They willingly took a massive hit to their remaining cash reserves to pay that $5.5 million.
True, which shortens the runway even more.
Paradoxically, yes, it shortens their runway even further. However, they bought themselves the most valuable thing a dying biotech can have, a clean balance sheet.
Right.
A pristine balance sheet with zero debt is vastly more attractive to a potential acquiring company than a slightly larger pile of cash that comes encumbered by international debt covenants.
So what does this all mean for the stock right now? Let's bring the listener's perspective back into the math here, because we are looking at an absolute nano-cap roller coaster right now.
We really are.
We are in April 2026, and QNCX is trending hard on the Reddit penny stock boards. Retail traders are going completely crazy over it. We've seen pre-market gains of 149%. The stock is just bouncing wildly between roughly 8 cents and 41 cents a share.
The volatility is staggering.
And the whole company is sitting at a nano-cap valuation of just $6 to $9 million.
Which is exactly why this specific environment requires extreme caution. The disconnect between the actual corporate reality and the market tape right now is profound.
Yeah.
The retail hype is being driven entirely by momentum algorithms, the low share float, and rampant speculation about an imminent buyout announcement. But the primary danger for the everyday investor lies in stale data.
Stale data, like old news.
Yes. If you go on certain retail brokerage platforms right now, the algorithmic data feeds will still show average analyst price targets for QNCX sitting at $7.25.
Wow. Wait, so if you're holding QNCX right now at, say, 20 cents,
Right.
you look in your phone and see a $7.25 price target, you might think you've hit the lottery.
Exactly.
At 8 to 40 cents a share, a $7.25 target looks like a 344% upside, or even 1,000% depending on the day's swing.
And it is incredibly dangerous to trade off those specific metrics right now.
Because they're outdated.
Entirely. Those $7.25 price targets almost certainly predate the Phase 3 failure in January. Wall Street analysts modeled those targets on the assumption that EDSP would be an approved commercialized drug generating tens of millions in revenue.
Right.
Since the drug program was scrapped and written down to zero, those targets are literal ghosts. They reflect the valuation of a company that no longer exists in reality.
Right, but I have to push back a little here. What does all that actually mean for QNCX investors right now? Are they really just buying a hollow shell, or is there hidden value left?
Well,
Because if you dig deep into the sources, the cupboards aren't entirely empty. They still have some remaining assets.
they do have a few things left, yes.
For example, there's NOV-004. The filings describe it as a preclinical bone-targeting anabolic peptide designed for osteogenesis imperfecta, which is brittle bone disease.
Correct.
In plain English, from what I understand, it's basically a localized growth signal sent directly to brittle bones to help them strengthen.
That's an accurate summary of the mechanism.
And then there's their 7.5% ownership stake in Lighthouse Pharmaceuticals. Lighthouse is the company that bought QNCX's legacy protease inhibitors, and Lighthouse just recently got a fresh injection of NIH funding.
Yeah, that is true. They did.
Doesn't that mean QNCX has some hidden gems left in the vault that a buyer might actually want?
Those assets do exist on the balance sheet, and we shouldn't dismiss them entirely. The 7.5% equity stake in Lighthouse Pharmaceuticals does hold potential future value, especially with the National Institutes of Health funding validating Lighthouse's ongoing research.
Right.
And NOV-004 is an undeniably interesting scientific asset for brittle bone disease. However, any evaluation of those assets must be filtered through the lens of time and capital.
Meaning they don't have enough of either.
Exactly. NOV-004 is strictly preclinical. Advancing a preclinical asset through Phase 1 safety, Phase 2 efficacy, and Phase 3 global trials takes roughly 7 to 10 years and tens of millions of dollars.
Wow.
QNCX simply does not possess that capital, nor do they have the runway to raise it.
So even if NOV-004 is a miracle cure waiting to happen, they literally can't afford to prove it to the FDA.
Precisely. The standalone value of NOV-004 right now is dictated solely by what another company is willing to pay in cash to buy the intellectual property rights to it.
I see.
Therefore, if we synthesize all of these moving parts, the Lighthouse equity stake, the fascinating but unfunded bone peptide, the clean balance sheet resulting from the brilliant debt settlement, and the dwindling remaining cash, the logical verdict is that QNCX has positioned itself as a prime candidate for a reverse merger.
A reverse merger. That term gets thrown around a lot on the message boards, but let's make sure everyone understands the actual mechanics of that play. Let me try an analogy here.
Please do.
So a reverse merger is kind of like a rich person buying a completely condemned, crumbling house, purely because it is already perfectly zoned for a mega mansion. They don't care about the broken house. They just want to skip the city's agonizing 5-year permitting process.
That analogy perfectly captures the corporate mechanism at play here. A reverse merger occurs when a private, well-funded company wants to enter the public markets and trade on the NASDAQ, but they want to skip the incredibly expensive, heavily scrutinized, and time-consuming process of a traditional initial public offering.
Skip the line, basically.
Exactly. Instead, they find a company that is already publicly traded but is essentially winding down its own operations, like QNCX.
Right.
The private company merges with the public shell, injecting their own assets and their own pipeline into it, effectively taking over the ticker symbol, the public listing, and the existing shareholder base.
So for a retail investor buying shares at QNCX at 20 or 30 cents today, they really need to realize they aren't investing in medical science or clinical trials anymore.
Not at all. Holding this stock right now is a pure, unadulterated speculative bet on the management team's ability to broker a financial transaction.
You're betting on the executives, not the scientists.
Right. The investor is betting that LifeSci Capital will successfully market that clean corporate shell in its NASDAQ listing to a private entity, and that they can negotiate a premium price before the cash reserves run out completely.
That is a fascinating shift in perspective. It really is a totally different game now than it was in December. You're trading corporate finance mechanics, not pediatric medicine.
It is. And filtering all this information reveals a rather profound reality about the life cycle of these publicly traded scientific ventures.
What's that?
In the high-stakes biotech world, a company's greatest asset sometimes ceases to be its groundbreaking medical pipeline or its brilliant scientists.
Wow.
When the science fails, its greatest asset becomes its corporate shell, its clean accounting, and its spot on the NASDAQ exchange. It forces us to ask, is QNCX right now just paving the way for a totally different, fully funded private biotech company to bypass the IPO line and go public through them?
That is the ultimate question hanging over the market right now. And it's exactly what makes watching this ticker so incredibly intense day in and day out.
All right, listeners, what's your take on the future of QNCX? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.